Right now, foreign investors own more Australian land than the entire United Kingdom. Not a company, not a city. A landmass bigger than an entire country, and most Australians have no idea it is happening in their own backyard. Somewhere out past the black soil plains of Queensland, past the red dust of the Northern Territory, past fence lines that stretch further than some entire nations, a quiet transformation has been taking place for decades. Cattle stations that once belonged to families who cleared the land, dug the bores, buried their dead under the same gum trees their grandchildren still walk past, are now owned by pension funds in Canada, investment groups in the United Kingdom, agribusiness conglomerates in Indonesia, and private equity out of Singapore. This is not a rumor. This is not a talking point from a late-night radio host. This is documented, tracked, and reported by the Australian Taxation Office itself, and the numbers are staggering enough to make even seasoned rural economists pause. As of the middle of 2025, foreign investors held just over 50 million hectares of Australian agricultural land. 50 million hectares. To put that into perspective, that is roughly 13% of all the farmland in the entire country, and that percentage has been climbing steadily year after year, without much fanfare, without much debate, and certainly without much attention from the average person scrolling past headlines about interest rates and housing prices. A year earlier, that figure sat at 12.7%. It is a slow, almost invisible creep, the kind of shift that does not make front-page news in a single dramatic moment, but instead accumulates quietly, station by station, paddock by paddock, until one day people wake up and realize the landscape of ownership has fundamentally changed. And here's the part that should really make you sit up. Almost 90% of that foreign-owned land is not being used for almond orchards or vineyards or boutique lifestyle farms. It is livestock country, cattle stations, sheep stations, the vast sunburned interior of this continent, where beef is bred, raised and shipped out to feed people in Tokyo and Jakarta, in Los Angeles and Shanghai. These are not passive investors parking money in a spreadsheet. These are entities that now control the very engine of Australian red meat production, the paddocks where the national herd grazes, the water rights that keep it all alive. So who exactly is buying up the outback? The numbers tell a fascinating story. The United Kingdom sits at the very top of the list, holding more Australian agricultural land than any other foreign nation, somewhere around 7.5 million hectares. Right behind them is China, holding roughly 6.5 million hectares, making it the second largest foreign holder in the country. Canada follows closely, driven largely by massive pension funds looking for stable, long-term returns in a politically secure country with strong property rights and a reliable legal system. In total, investors from 73 different countries are registered as holding interests in Australian farmland. 73. That is not a niche trend. That is a global phenomenon, and Australia has become one of its primary destinations. Why Australia? Why has this sunburned, drought-prone, flood-battered continent become such a magnet for foreign agricultural capital? The answer lies in a combination of scale, stability, and simple economic logic that most people never stop to consider. Australia offers something incredibly rare on a global scale: enormous tracts of land, still relatively affordable compared to farmland in Europe or North America, combined with a stable democracy. Strong property rights, transparent courts, and a legal system that foreign investors trust will not suddenly nationalize their assets or seize their land without compensation. When a pension fund in Toronto is deciding where to park billions of dollars for the next 50 years, they are not just looking at yield. They are looking at political risk, currency stability, and the rule of law. Australia checks almost every box. Then there's the food security angle, which becomes more relevant every single year as the global population grows and climate patterns become more unpredictable. Countries that cannot feed themselves domestically, whether due to limited arable land, water scarcity, or simply population density that outpaces agricultural capacity, have increasingly looked overseas to secure long-term access to food production. China's growing appetite for beef and protein, driven by a rapidly expanding middle class demanding more meat in their diets, has been one of the single biggest drivers of Chinese interest in Australian pastoral land over the past 15 years. When you cannot grow enough beef at home and you have the capital to spare, you go and buy the paddocks where that beef is already being raised somewhere else. Let's talk about some of the actual deals, because the abstract numbers only tell half the story. The real story lives in individual transactions, station by station, family by family, and some of these deals are enormous. Take Rawlinna Station in Western Australia. This is not some modest little holding. Rawlinna is, by land area, the largest sheep station in the entire country, sprawling across roughly 1 million hectares of the remote Nullarbor, an area of land so vast it is genuinely comparable in size to the city of Sydney. For decades, Rawlinna belonged to Jumbuk Pastoral, a family farming dynasty with roots going back nearly 140 years, one of the oldest and most established pastoral operations in Australian history. And then, in a deal that sent ripples through the rural property market, Jumbuck agreed to sell Rawlinna to Consolidated Pastoral Company, a privately owned agricultural business based in the United Kingdom and controlled by British investor Guy Hands. The deal included not just the land itself, but a flock of approximately 30,000 sheep, and it required formal sign-off from Australia's Foreign Investment Review Board, along with approval from the Western Australian government to transfer the pastoral lease, one of the oldest sheep dynasties in the country, effectively handing over its flagship property to offshore capital. But Consolidated Pastoral Company was not stopping there. This same British-controlled operation went on to acquire the Beetaloo Station aggregation in the Northern Territory, a sprawling collection of properties covering more than 1 million hectares, in a transaction reportedly worth over $315 million. With that acquisition, Consolidated Pastoral Company now controls 12 major pastoral aggregations across the country, an agricultural portfolio estimated to be worth somewhere in the vicinity of $1.6 billion. Think about that for a moment. A single British-controlled company now oversees an empire of Australian grazing land worth well over $1.5 billion, built paddock by paddock, station by station, largely through acquisitions of historic Australian pastoral operations. And it is not just the British. Canadian capital has been moving aggressively into Australian agriculture as well, often through pension funds that most ordinary Australians have never even heard of. PSP Investments, a major Canadian pension fund manager, responsible for managing retirement savings for Canadian public servants, completed a transaction worth approximately $500 million to acquire full ownership of the Kuba agricultural aggregation near Griffith in New South Wales. That single deal alone was worth $500 million, and it was just one piece of a much larger puzzle. Following that acquisition, PSP Investments now controls an estimated $8 billion worth of Australian farmland and water assets. $8 billion. That is not a hobby investment. That is a serious, deliberate, long-term strategic position in Australian agricultural land, backed by the retirement savings of Canadian workers who most likely have no idea their pension contributions are quietly buying up sheep and cattle country on the other side of the planet. Then there is Aruna Station in the Northern Territory, a 147,000-hectare property located about 90 kilometers southwest of Katherine in the Upper Victoria River District, sold for $44 million to a South American-backed agricultural group called Cross Pacific Investments. This deal included the land, fixed improvements, equipment, and an estimated 15,000 head of cattle, and it made this particular station the 5th Northern Territory asset secured by the same investment group, bringing their total landholding in the region to roughly 756,000 hectares. Let that sink in for a second. Nearly 750,000 hectares of Northern Territory cattle country, controlled by a single foreign-backed investment group, built through a steady, methodical accumulation of station after station after station. Now, some of you might be wondering, does anyone actually try to stop this? Is there any oversight at all? Or is Australia simply an open market where anyone with enough money can buy up half the outback with no questions asked? The answer is more complicated than a simple yes or no, and it involves a government body called the Foreign Investment Review Board, commonly known as FIRB, which is responsible for screening major foreign investment proposals and advising the federal treasurer on whether they should be approved. Here is how it actually works in practice. Any foreign person or entity looking to acquire agricultural land in Australia must seek approval from FIRB once their cumulative agricultural land holdings in the country exceed roughly $15 million in value. And this is a crucial detail that most people miss. It is a cumulative threshold, not a per-transaction threshold. That means if a foreign investor already owns $10 million worth of Australian farmland and wants to acquire another $6 million parcel, they trigger the review requirement, even though that individual transaction alone might seem relatively modest. The general policy guiding these approvals is that the sale process must be open and transparent, meaning the property needs to have genuinely been offered to the broader market, including Australian buyers, rather than being quietly negotiated behind closed doors exclusively with a single foreign purchaser. But here is where it gets interesting, and where a lot of public frustration has historically been directed. For a long time, the sale of agricultural land itself was actually exempt from FIRB's attention, unless a transaction involved acquiring an entire company whose total assets exceeded a much higher threshold, historically set at over $200 million. This created what critics described as a significant loophole, allowing enormous tracts of farmland to change hands with minimal government scrutiny, so long as the deal was structured as a direct land purchase rather than a corporate takeover. Rural advocates and some politicians spent years arguing that this system was fundamentally broken, that Australia was essentially allowing its most strategically important asset, the very land that produces its food, to be sold off with less oversight than would apply to buying a mid-sized business. This tension came to a head most dramatically with the saga of S. Kidman and Company, a case that became the single most famous example of foreign investment controversy in modern Australian agricultural history. Kidman was not just any pastoral company. Founded all the way back in 1899, Kidman was, and in many ways still is, Australia's largest private landholder, controlling approximately 1.3% of the entire country's total land area and 2.5% of all Australian agricultural land. 10 separate cattle stations spread across South Australia, Western Australia, the Northern Territory, and Queensland, covering over 100,000 square kilometers, an area almost as large as the entire American state of Virginia. This was, without exaggeration, one of the largest privately held agricultural empires on the entire planet. When Kidman went up for sale, the bidding attracted serious interest from Chinese investment companies, reportedly locked in a competitive bidding battle against each other, driven in large part by China's growing demand for beef and protein as its middle class expanded and dietary habits shifted toward more meat consumption. But then, Treasurer Scott Morrison stepped in and did something that sent shockwaves through the agricultural investment world. He blocked the sale entirely, declaring it contrary to the national interest. And his reasoning went beyond simple economic nationalism. Half of one particular Kidman property, the massive Anna Creek Station, sits inside the Woomera Prohibited Area, a restricted military zone used for weapons testing. Morrison argued that allowing a foreign entity to acquire a controlling stake in land that overlapped with sensitive defense infrastructure represented a genuine national security concern, not merely an economic or cultural one. This rejection was not a one-time event either. Morrison blocked multiple proposed versions of the Kidman sale over an extended period, each time citing similar concerns, even as the bidding parties adjusted their offers and ownership structures to try to satisfy government objections. It took years of negotiation, restructuring, and political maneuvering before a solution was finally reached. Eventually, an approved proposal emerged in which Anna Creek and its outstation, the Peak, were excised entirely from the deal, and instead acquired separately by a local farming family whose existing properties adjoined Anna Creek. The remainder of the Kidman portfolio was then sold under a structure where Gino Reinhardt, Australia's wealthiest woman and executive chairman of the Hancock Prospecting Group, took the majority stake, alongside a significantly reduced minority stake held by a Chinese investment partner. Under this final arrangement, Kidman's overall Australian ownership percentage actually increased substantially, moving from roughly 66% to nearly 75% Australian-controlled. Morrison, announcing the approval, was careful to frame it not as a rejection of foreign capital in general, but as evidence that Australia would continue welcoming foreign investment wherever it aligned with the national interest, while drawing a firm line around assets deemed too strategically sensitive to risk. The Kidman saga became a defining case study, cited repeatedly in policy discussions ever since, precisely because it illustrated both sides of this ongoing debate simultaneously. On one hand, it proved that Australia does have mechanisms to intervene when a proposed foreign acquisition genuinely threatens national security or strategic interests. On the other hand, it also proved just how difficult, slow, and politically fraught that intervention process can be, and how many other, smaller transactions likely proceed every single year without anywhere near the same level of scrutiny simply because they lack the same dramatic security angle that made Kidman impossible to ignore. It is also worth being honest about something that often gets lost in the more dramatic framing of this issue. Not every large station sale ends up in foreign hands, and Australian buyers remain incredibly active and competitive in this market, often outbidding international interests for the largest and most valuable properties available. Just this year, 3 enormous South Australian stations, Commonwealth Hill, Mabella, and Bulgunia, originally owned by the very same Jumbuck pastoral dynasty that sold Rawlinna to British interests, were instead sold to Charlie Shahan, an Adelaide-based Australian billionaire, through his family's agricultural investment vehicle. Shahan, whose family built their fortune through the OTR convenience store chain before selling it to Viva Energy, described the acquisition as a lifelong ambition and a long-term family investment, explicitly framing it as a commitment to supporting existing operations and building on the foundations already established, rather than simply extracting value and moving on. These 3 stations combined cover nearly 1.3 million hectares, meaning the single domestic transaction represents a landholding roughly comparable in scale to some of the largest foreign deals discussed earlier in this very script. Similarly, when Rural Funds Group, an Australian-listed agricultural investment company, decided to offload 4 major cattle properties across Queensland and Victoria in a combined deal worth $255.6 million, the buyers were not exclusively foreign either. Ruin Station, the largest single property in that portfolio, sold for $106.9 million to the Caldwell family, a New South Wales-based operation already well known for running the respected Millwilla Angus cattle stud. That is a domestic family buyer, competing successfully at the very top end of the market, outbidding whoever else was in the running for one of the most valuable individual cattle properties sold in Australia that entire year. Meanwhile, other properties within that same portfolio, including the historic Kabungra station in Victoria, did attract foreign buyers and remain subject to the standard Foreign Investment Review Board approval process before those sales can be finalized. Industry insiders who track these rural property markets closely have actually pushed back at times against the narrative that foreign buyers are simply sweeping in and out-competing Australians at every turn. Property analysts covering the northern cattle industry have noted periods where there were actually more domestic bidders than foreign ones showing up for auctions of large-scale cattle assets, pointing to wealthy Australian buyers like Gina Reinhart, Andrew Forrest, Kerry Stokes, and Brett Blundy, all of whom have been willing to pay serious money to secure major pastoral properties for themselves. In some cases, foreign-owned assets have actually flowed back into Australian hands over the years, as offshore investors, sometimes speculative in nature, chose to exit the market and realize gains on properties they had acquired years earlier, selling back to local operators who saw an opportunity to reclaim ground that had previously left Australian control. So where does the concentration of foreign ownership sit geographically across the country, and why does that distribution matter? The Northern Territory stands out as the most heavily concentrated region, with roughly 27.8% of its total agricultural land now under foreign ownership, by far the highest proportion of any state or territory in the nation. This makes a certain kind of intuitive sense when you consider the nature of Northern Territory pastoral country. These are enormous. Remote, capital-intensive cattle stations, often requiring hundreds of millions of dollars in infrastructure, water access, fencing, and cattle stock just to operate at meaningful scale. That kind of capital requirement naturally favors large institutional buyers, whether foreign pension funds or major agribusiness conglomerates, over smaller domestic family operations that may lack the balance sheet to compete at that level. Queensland, meanwhile, holds the largest absolute area of foreign-owned agricultural land of any state, at just over 17 million hectares, even though its overall percentage of foreign ownership is somewhat lower than the Northern Territories, simply because Queensland's total agricultural land base is so much larger to begin with. Queensland has long been ground zero for large-scale cattle station transactions, home to some of the most significant pastoral aggregations in the country, and it continues to attract heavy interest from both domestic and international buyers looking to secure a foothold in one of the world's most significant beef-producing regions. Water rights represent another layer of this story that deserves attention because land and water in the Australian agricultural context are deeply intertwined, and foreign ownership of water interests is actually tracked separately under the same federal reporting framework that monitors farmland ownership. As of the middle of 2025, foreign ownership of water interests across Australia stood at approximately 12.7%, up slightly from the year before. In a country as drought-prone and water-constrained as Australia, control over water access can matter just as much, if not more, than control over the land itself. And it adds yet another dimension to the broader conversation about who ultimately controls the resources underpinning Australian food production. Critics of the current system, and there have been many over the years across the political spectrum, have argued that Australia needs a more coordinated national food security strategy, one that goes beyond simply tracking foreign ownership after the fact, and instead actively considers the long-term strategic implications of allowing so much productive agricultural land to fall under offshore control. Some have called for lowering the reporting thresholds that trigger government scrutiny, arguing that the current system allows too many significant transactions to proceed with minimal transparency or public awareness. Others have pushed back against this framing entirely, arguing that foreign capital has historically been essential to developing Australian agriculture in the first place, providing the investment needed to build infrastructure, improve productivity, and keep struggling family operations viable during difficult economic periods, particularly during prolonged droughts. When access to capital can genuinely mean the difference between a station surviving or being forced into liquidation. There's a version of this argument that frames foreign investment not as a threat, but as a lifeline. Family-run pastoral operations facing succession challenges, aging owners without a clear next generation willing or able to take over the business, or simply crushing debt loads built up during years of drought and low commodity prices. Sometimes find that a well-capitalized foreign buyer represents their best, and sometimes only realistic path to an exit that preserves jobs, maintains operations, and provides fair value for decades of accumulated family investment in the land. Several of the foreign buyers mentioned throughout this script have explicitly committed to retaining existing staff, continuing current operations, and investing further in productivity improvements rather than stripping assets or converting land to other uses. When Consolidated Pastoral Company acquired Rawlinna, for example, the rural property agent handling the sale confirmed that all existing employees would be offered ongoing roles at the station, suggesting a continuity of operations rather than a disruptive takeover. At the same time, there remains a genuine and understandable emotional weight to this issue that pure economic analysis often fails to fully capture. For many Australians, particularly those with generational ties to rural communities, the outback represents something deeper than a simple economic asset to be bought, sold, and optimized on a balance sheet. These stations carry family history, community identity, and a sense of national heritage that does not translate neatly into a spreadsheet of hectares and dollar values. When a station that has been in the same family for 140 years changes hands, and the new owner is a private equity fund based in London or a pension manager based in Toronto, something is lost that goes beyond the purely financial terms of the transaction, even if the deal itself was conducted fairly, transparently, and with full regulatory approval. Looking ahead, there's little indication that this broader trend of foreign capital flowing into Australian agricultural land is going to reverse anytime soon. Global demand for protein continues climbing as populations grow and economies develop, particularly across Asia. Climate change continues placing pressure on agricultural production in other parts of the world, making stable, well-governed countries with abundant land and water resources, like Australia, increasingly attractive as long-term strategic assets rather than simply short-term investment opportunities. Pension funds and sovereign wealth vehicles around the world continue seeking exactly the kind of stable, long-duration returns that agricultural land in a country like Australia can reliably provide over multiple decades. What does seem likely to continue evolving, however, is the level of public scrutiny and political attention directed at these transactions. The Kidman case demonstrated that Australia's government is willing to intervene decisively when a deal touches on genuine national security concerns and ongoing public debate about transparency, reporting thresholds, and food security policy suggests that future significant transactions, particularly involving Chinese state-linked entities or extremely large-scale acquisitions, will likely continue attracting close attention from regulators, journalists, and the broader public alike. Whether that translates into meaningful policy changes, tighter thresholds, or simply continued monitoring under the existing framework remains to be seen, and will likely depend heavily on the political climate at any given moment, along with broader shifts in Australia's economic relationships with its major trading partners. What is clear, beyond any doubt, is that the story of who actually owns the Australian outback is far more complicated, far more dynamic, and far more consequential than most people realize. It is not a simple story of foreign predators swooping in to strip Australian farmers of their birthright, nor is it a simple story of beneficial foreign capital rescuing struggling family operations from financial ruin. It is both of those things simultaneously, playing out across thousands of individual transactions, each with its own particular circumstances, motivations, and consequences. Behind every hectare counted in that 50 million hectare total is a specific station, a specific family, a specific set of decisions made under specific pressures, whether that pressure came from succession planning, drought, debt, or simply the enormous, tempting offer of a price that made walking away impossible to refuse. It is also worth noting that this pattern of foreign ownership is not limited to British and Canadian capital, or even to the giant institutional funds that dominate headlines. Indonesian agribusiness has quietly built a significant footprint of its own in the Northern Territory through companies like Santori, a subsidiary of the large Indonesian conglomerate Japfa Group, which has owned major cattle assets including the sprawling Riverine and Inverway stations, covering roughly 500,000 hectares between them. Malaysian interests, through entities like the Sarawak Economic Development Corporation, have similarly held large Queensland cattle aggregations, while Argentinian pastoral groups and American agricultural investors have moved in and out of the market at various points as well. This diversity matters because it complicates any attempt to reduce the story to a single narrative about one country or one type of buyer. The truth is a genuinely global marketplace, with capital arriving from Asia, Europe, and the Americas, pursuing different strategic goals. And ownership is not always permanent either. Property analysts have observed periods where foreign owners, particularly more speculative investors who purchase stations expecting rapid appreciation, have chosen to exit the Australian market entirely, selling properties back into local hands when conditions shifted or when the initial investment thesis simply did not play out the way it was originally expected to. The next time you drive past a cattle station out in the vast, empty distances of rural Australia, or see beef on a supermarket shelf somewhere on the other side of the world with an Australian origin label, it is worth remembering just how complex the ownership story behind that meat, that land, and that landscape genuinely is. Somewhere out there, on a piece of land the size of a small European country, cattle are grazing under the same brutal sun that has always beaten down on the Australian interior, tended by station hands doing the same difficult, essential work that has been done there for generations. While ownership of that land itself sits recorded not in a local property register, but on a spreadsheet in Ottawa, or London, or Beijing, or Jakarta, quietly tracked, quietly growing, and quietly reshaping who ultimately controls one of the most valuable, most productive, and most fiercely contested landscapes on the entire planet.